Tom, what do you think demand's going to look like if, in fact, we do see this last maybe longer than we had initially anticipated? That, of course, could potentially impact production, vehicles available, which would then impact price. I guess, how material of a movement could we see if this lasts much longer than you and many of forecasters have been expecting?
Yeah, that's really the question that everybody's been asking. A 6-week period really would probably help the OEMs keep pricing elevated. It's probably bad for customers like us, right? But that only lasts for a few weeks. So the pricing impact of a 6-week work stoppage, it would keep things elevated for a limited period. If it's several months, yeah, now pricing stays elevated for perhaps an entire quarter. It keeps the pressure on volumes down. But I mean, look, these OEMs dealt with this, right? We had pandemic, we had semiconductor crisis, shortages is nothing new. If anything, some of the OEMs probably like this, right? Because it means they keep pricing elevated, and that's like really what's giving them record profits. But yeah, the longer this lasts, it's just not good optics. Also, it creates an affordability problem for folks like us. If we can't just afford to buy the car, it doesn't matter how much they'd love to price it, right? So the worst case scenario is if they're forced to drop pricing because retail buyers can't afford the car, and you have production problems because of a longer strike. That's the perfect storm that could hurt them a lot, because then you have both bad pricing and bad volumes. That would be the ultimate problem. But so far, we haven't seen evidence of that.
What do you need to hear from not just the automakers and what they're putting forward to make sure that they're actually going to be able to maintain margins that the street has come to expect for years on a previous partnership or a previous deal that they had with the UAW? And how will that significantly shift your calculus going forward?
Yeah, that's the other big question, is what happens to margins with these labor cost increases? It's interesting. I think there's been some agreement coming in on both sides. They're moving closer to each other. So that's why I don't really think it'll be months and months. But we've done some math on the margin impact. It's actually not as severe as a lot of people think it is. It's maybe 100 to 150 basis point of margin hit because of, let's say, a 30% wage increase, which we think would be the midpoint of where both sides are. But the bigger problem is if price mix falls because of affordability, we're at record level pricing, right? Just try to buy a new car now. If that falls if it's back to 2019 levels, that's like 400 basis points. That's like 4 times what UAW wage increase would do, right? It probably won't be that severe, but if I look at my peer group, other folks like me and their estimates, we're not factoring in any of this. That's the scary part, is estimates probably need to come down. Now, the buy side, the investor community, you can see where the stocks are. They're already pricing in, I think, like a 20 to 30% reduction in numbers. So, maybe the stocks are fairly valued from the buy side perspective, but my peer group definitely needs to take their numbers down.